Hello friends, today we will discuss on non-fund based working capital credit facilities that we are also call them as quasi credit facilities. Okay, so let's start. So first of all, why non-fund based? What is its benefit and how it is different from fund based credit facilities? At the time of providing the facility, issuer of the facility, generally the bank does not disburse any fund. So when we issue a non-fund based facility, there is no disbursement of fund, there is no involvement of fund. Okay, so beneficial for the customer since they can increase their business without taking any fund from the banks. So customers are not taking any fund from the banks, so it is beneficial for them. Beneficial for the banks as well since these facilities help them to earn income without the risk of asset liability mismatch and interest rate risk on the liability and asset side. Since banks are not disbursing any fund, so there is no risk of asset liability mismatch is there and no interest rate risk is there. In case the customer on behalf of whom the bank issues this facility does not keep its commitment, this process is called devolvement. The bank would pay the amount. So in case of development only, the non-fund based facility is converted into a fund based facility. Okay. So one of the non-fund based facilities, letter of credit. So we have discussed our fund based facilities, working capital fund based facilities in our last presentation. Those who have not seen that facility, not watched that presentation, they can watch it, and there we discuss about non-fund based credit facilities, that is bank guarantee and letter of credit. So let's look at letter of credit. So letter of credit taken birth in order to facilitate mainly the international trade. So it answers the following issues arising in course of international trade. That is, does the seller know the buyer? What is creditworthiness of the buyer? Will the buyer make the payment unless he gets the delivery of goods? Regulated by the rules laid down by International Chamber of Commerce in the name of Union Form Custom and Practices for Documentary Credit, UCPDC. Okay, so let's move on to the definition of letter of credit. A letter of credit is a written undertaking whereby a bank, issuing bank, either acting at the request of and under instruction from its customers, the applicant or the buyer of good, or on its own behalf, agrees to make payment to a third party, the beneficiary or the seller of good, or undertakes to accept and pay bills of exchange drawn by that third party. So here the applicant is the buyer of good and the beneficiary is the seller of good. Instructs another bank to make payment or accept and pay such amount, or authorizes another bank to pay against stipulated documents provided the terms and conditions of the LC are strictly complied with. So parties to, how many parties are there in LC? Importer, that is the applicant or buyer of the good. For example, suppose Tata. Issuing bank, suppose Tata is banking with SBI. Exporter, beneficiary, suppose Tata is buying from Germany. Okay. Correspondent bank or advising bank, HSBC, it is there in Germany. Okay. Pay bank or negotiating bank who finally gets the money if the banker is a small bank. Otherwise the correspondent bank and the pay bank are the same. So Germany's banker is HSBC. Okay. So two aspects of LC. There are two aspects. Payment to be made on due date by the customer without fail. Since the bank is giving the LC, in case of non-payment to the bank by the customer on due date, the issuing bank would pay from itself to the negotiating bank. This would reduce the credit rating of the company in the books of issuing bank. When LC is opened, certain charges need to be paid to the bank concerned. So there is an additional cost for purchase under LC. Now what we need for opening of LC: application form, terms, okay, invoice documents, bill of lading, railway receipts, air consignment notes, marine insurance policy, certificate of origin, custom certificates. So let's see the flow cycle of LC. Okay, so this slide is very important to understand the LC. So let's start. So there is an applicant, okay, the buyer or drawee. These are same. And on the other side there is a beneficiary, seller or the drawer. Okay, so Tata is buying from Germany. Okay, some company from Germany. Okay, so suppose the Tata is buying a machine from Germany. Okay, so the company Germany is the beneficiary here and Tata is the applicant. Okay, so beneficiary sends invoice. Okay, here the applicant bank applies to the issuing bank. So the applicant bank is SBI, suppose. Okay, opening bank. So beneficiary bank is sent the invoice. So this is the advising bank or confirming bank. In case this seller bank doesn't know the buyer bank, so there is a advising bank or confirming banks. Okay, which advises the LC or confirm the LC issued by says SBI. And if since the seller's bank knows the buyer bank, then advising and confirming bank can be the same. Okay, now LC is open. Advising bank has advised LC in point number 4 here. Okay, here. Then beneficiary ships the goods. Okay, there come a negotiating bank. The beneficiary submits the document for negotiation to the negotiating bank. Okay, and after submission of the document, payment is made. Here is the main feature of LCE. Once the document is submitted to negotiating bank will pay the amount to the beneficiary. It doesn't matter that the goods shipped has reached the applicant or not. So that's why it is also called that the letter of credit goes by the document. Now negotiating bank sends the document to the issuing bank and asks for payment, and issuing bank sends the document to the applicant for acceptance. Okay, so the applicant will check all the documents and confirm the issuing bank. Issuing bank will send confirmation to negotiating bank and negotiating bank will do the payment. And now the goods will be received by the buyer, and after receiving the good, the buyer will pay to the issuing bank, that is SBI. Okay, so let's go for types of letter of credits. First is documentary and clean LC. In case of clean LC, issuing bank undertakes to honor bills without security of any documents. So it is clean without any security. Clean LC is issued by the banker at the request of the customer of sound financial position or security. Banks would be extremely wary of opening clean LC where the risk is quite high. In case of documentary LC, the issuing bank undertakes to honor the bills drawn if it receives the document of title such as bill of lading, insurance policy, certificate of origin, and invoice. Okay. Another type is revocable or irrevocable LC. As the word suggests, it is self-explanatory. Revocable LC means the issuing bank reserves the right to cancel or modify the credit at any moment without any notice to the beneficiary. It is nowadays it is an old concept. Mainly the LCs are irrevocable. An irrevocable LC is one which cannot be amended or cancelled without the specific consent of the beneficiary. Issuing banker gives an absolute undertaking. Okay. The third is sight and acceptance LC. Sight credits are those in which the paying bank or issuing bank or confirming bank undertakes to pay the amount of the bill at sight. That is immediately on demand provided the document are checked and found to be in order. Okay. So it is paid on sight. Acceptance credit provide for the credit period to be extended to the applicant by the beneficiary. These are also called usage LC, where the applicant enjoys credit for some period. Okay. In case of sight LC, once the good is received, the applicant needs to pay the issuing bank. In case of acceptance credit, the applicant has some time to pay to the banker. Revolving credit and fixed credit. In case of fixed credit LC, the issuing banker specifies the amount and the period up to which the beneficiary can draw one or more bills. In case of revolving credit, the issuing bank specifies total amount up to which bills drawn may remain outstanding at a point of time. These are intended to finance repetitive supplies of goods or services at certain interval of time. A revolving credit LC is automatic in operations and the process continues till the period of LC expires. Revolving credit LC does not require renewal. Confirmed and unconfirmed LC. A confirmed LC is one where the advising bankers of the exporter's country at the request of issuing banker add confirmation to an irrevocable LC. In such case, advising banker takes upon itself the liabilities as that of the issuing banker. If the advising banker knows the worthiness of the issuing banker, in that case, it occurs. Okay. It serves as a perfect security to the beneficiary. In case no such confirmation has been given by the advising banker, the LC remains as unconfirmed. In case of unconfirmed LC, the advising banker will not incur any obligation towards the beneficiary. Transferable and non-transferable. So a transferable LC would authorize the beneficiary to ask the paying bank to transfer the amount of credit in full or part to one or more other beneficiaries. A credit can be transferred only if it is specifically mentioned that it is transferable. Such a transfer is resorted to in cases where the first beneficiary is just a trading agent and the goods are manufactured or processed by another party. In case the transfer is not possible, it is known as non-transferable LC. Now back-to-back LC. These LCs are used in a situation where the beneficiary and irrevocable LC may not be the actual supplier of goods. On his request, his banker may open another LC favoring the actual supplier based on the original credit. Thus, one LC is backed by another LC. Terms of second LC need to be tailored to ensure that the first beneficiary can meet the terms of credit in his favor and he would substitute certain documents to meet the requirement of first credit. Now its implication by issuing bank. The issuing bank acts on behalf of and under instruction from the applicant only, who is the buyer of goods and services. In India, general practice is that the applicant should have an advance limit, usually CC, with the issuing bank. Further, there should be sufficient undrawn balance in the limit. Now, confirming bank takes up the identical responsibility and risk as the issuing bank unless the confirming bank is fully satisfied with the credential of issuing bank. It ought not to undertake this onerous responsibility. Banks have to be extremely careful when confirming LC issued by issuing bank in a financially troubled countries. Now, how do we assess the LC requirement of a company? Suppose a company buy, consumes a raw material of rupees 3600 and out of which they buy on credit from other countries around rupees 2400. Time of advising LC is 10 days, shipment time is 20 days and credit period between seller and borrower is 30 days. So total period is 60 days. So assuming 360 days in a year, there would be a 6 cycle in a year. If the raw material bought on credit per year is 2400, then the limit of LC requires 2400 by 6, that is rupees 400. I think it is clear. Now let's move to bank guarantee. So coming to bank guarantee, a contract to perform the promise or discharge the liability of a third person in case of his default. So in bank guarantees on behalf of the applicant to the beneficiary. Okay. The obligation of the guarantor arises when there is a default to perform the promise by the person on whose behalf guarantee is given. So the obligation will arise when the applicant, the customer of a bank, will not keep his promise, then only bank has to pay. Therefore, there is a probability of it turning into a fund-based credit facility, though initially they are non-fund-based credit facility. Assessment of bank guarantee. Suppose a Kolkata Metropolitan Development Authority KMDA decide to construct a bridge. It asks for a bid of prospective customer companies, civil contractors. Okay. After successful bidding, KMDA will select one contractor, say A, for the job. Okay. Since the construction job is of very high volume in nature, KMDA would provide advance for mobilization of the job. This is called mobilization advance. Okay. Now KMDA also wants some kind of mechanism so that after taking the money, A should fulfill its responsibility. KMDA would ask bank guarantee to be submitted by A. A would approach a banker to issue a guarantee on its behalf to KMDA. Suppose A is a Dilip Buildcon, a contractor company, and KMDA had awarded a contract to Dilip Buildcon, and the banker of Dilip Buildcon is suppose SBI. So Dilip Buildcon will go to SBI to have a bank guarantee in which SBI will guarantee on behalf of Dilip Buildcon to KMDA. So in a bank guarantee, there are following parties: the applicant, here the company A, or Dilip Buildcon on whose behalf the bank issues the bank guarantee. Bank is SBI. Beneficiary is KMDA. Issuing bank is suppose SBI. We have already discussed. Now how the guarantee mechanism works, like we have seen in LC, guarantee mechanism is Bank guarantee is simple than LC. So applicant is B, A is the beneficiary. So here KMDA, A is KMDA and B is our Dilip Bilcon. Oh, okay. So A asks B to open BG and C is the issuing bank of the applicant Dilip Bilcon. So applies bank for opening BG and here say this is SBI opens a BG, delivers to the beneficiary. Okay, now gives advance to the contractor to perform. Now how many types of BG? There is a two types of BG, one a financial guarantee and the performance guarantee, and there is other deferred guarantee. Okay, so fine, let's talk about financial guarantee. The bank undertakes to pay a stated sum of money to the beneficiary of the guarantee on default of promise by the customer for whom the guarantee is given. Okay, these are guarantees issued in respect of purely monetary obligations. Correct? The guarantee is given for monetary obligation. Normally, these are issued in lieu of payment of tender deposit, earnest money deposit, custom duty, excise duty, income tax, and guarantee payment of good purchase or credit. Now, another is performance guarantee. The bank guarantees that the customer on whose behalf the guarantee is given by the bank will perform the contract undertaken. On his failing to perform the same, the banker shall make good the loss caused to the beneficiary by limiting him financially to a sum not exceeding the amount undertaken in the guarantee. Okay. If it is not done, the bank will pay and the limit is decided in the guarantee. The difference lies in the additional factor, that is performance by the customer guaranteed by the banker in case of the latter. The third one is deferred guarantee. The deferred payment guarantee which the bank issue contains an undertaking on the part of the banker to guarantee due payment of deferred installment by the customer on due date to the supplier. Deferred payment guarantee is usually non-funded, substituted for term loan. Basic requirement: the amount and expiry date should be definite and unambiguous. So it should be clear. The guarantee should be in respect of definite object or on the happening of a definite event. The amount should be payable on demand, that is declaration of default by the beneficiary. The bank's obligation should be reduced to payment of a specified amount, that is to the amount agreed. It should pertain to a bona fide commercial trade transaction. The special issues: security. In all credit facilities, it is cardinal principle that the credit provider should get the security of the asset that is created with the credit facility. However, this is not applicable for all BG except for some cases such as advance payment guarantee. Usually, bank asks for some collateral in the form of charge on fixed and current asset of the borrower to cover the guarantee, and bank also asks for cash margin, that is around 20 to 25%, and it may vary. While it is difficult for the value of collateral to fully cover the total amount of guarantee, it should be ensured that the formalities relating to creation of security are invariably completed before the guarantees are issued. Commission. The commission or the earning of the bank for issuing the guarantee should ideally cover the risk and cost of issuing the guarantee. This could depend upon the credit profile of the customer, but in case BG, banks in India levy uniform rates of commission for all the customers. Generally, the cost of issuing BG consists of two elements: administration cost and cost of apportioning bank's capital for the business. Indian banks levy a higher rate of commission on financial guarantees compared to performance guarantees. Okay, overall limit on guarantees. RBI has stipulated that the banks should be extremely careful in issuing guarantees not backed by security. So, on clean guarantees, it is impractical. It doesn't happen in banks. They take securities. 20% of unsecured guarantees and the total outstanding clean advance should not be more than 15% of total outstanding advance of the bank. So, this is the overall guideline that a bank should have a 20% of unsecured guarantee and the total outstanding clean advance without any security should not be more than 50% of total outstanding advance of the bank. Period of expiry. All bank guarantees should have a specified expiry period and the beneficiary should not be vested with any rights to the guaranteed amount for an event happening after the expiry date. Okay. Thank you friends for watching. Please subscribe and comment for more videos.